Hi everyone, welcome back to another presentation from Sharewise. We're going to be talking about how wars affect the market. So this is just another market update. We're going to be talking about how what's been going on, realistically the uncertainty, the war in Israel. We're going to be talking about the US market and the Australian market and how they've gone through with regards to what's been happening around the world and what they've done in the past when it comes to wars. But the other thing we're going to be touching on at the end is what stocks we're basically buying. So we've got a stock recommendation, a free one that we've been sending out to a lot of our clients, and you can download that at the very end. Now, what's been happening in the market? Well, currently investors are seeing very much unprecedented uncertainty in the market. We've got the invasion of Hamas on Israel, which is throwing out a lot of uncertainty. We're seeing increasing volatility in the market. There's no clear direction of which way it wants to go. And realistically, the market is already underperforming for this calendar year. We have the global economies under major stress due to the deleveraging process. There's a lot of credit and debt out there that remain unpaid at the moment, and there could be a default. But the reason for that is, well, sticky inflation. We're still maintaining higher rates of interest rates due to the inflation being so sticky. And that's not getting any better with regards to the war. We have higher cost of living occurring because of that, as a result of that. And consequently, well, we have falling savings resulting in less disposable income and a need for changing in consumer behaviour, which will come about. It will come. And so realistically, okay, Israel is a major political play in the Middle East, and we could see a lot more pressure being put on oil, a lot more pressure being put on technology coming out of the Middle East, and realistically, those defensive sort of stocks could go for a bit of a run. But how does, in more depth than in the past, does the market perform? Well, historically, wars have had a negative impact on the SP 500 in the short term, especially. We have initial uncertainty and instability introduced into the economy, which decreases the investor sentiment. And as a result, the market is unsure how contagious the geopolitical risk is. And as a result, well, we see a bit of a downturn swing. During World War I, World War II, the SP 500 performed poorly, which makes complete sense. The outbreak of World War I in 1914 saw the index fall 18% in just 3 months. However, from 1920 to 1929, stocks quadrupled in value. And so we saw that as well with World War II, which was even more significant impact. We had the index dropping 30%, but in the following year 30% in the year following the start of the war. The Gulf War also in 1990 had a negative impact on the market, with the index dropping 15% in 6 months following the outbreak of the conflict. But I think what's clear, and what's clear by the graph to the right of the screen, is that yes, even though in the short term, there is a downward spiral, generally the market recovers and it grows quite consistently, quite quickly. And what wars are good at is innovation, and it forces countries that haven't been innovating to jumpstart. And that brings us to the Australian market. Now, the Australian market does really well, funny enough, when it comes to war times. And realistically, that comes from an increase in spending from the government on defence and just on an economic scale, it boosts the economy quite a bit. And the corporate balance sheets profit from it. Additionally, war can lead to high demand in certain commodities such as oil and metals, which can be beneficial for the Australian companies that produce these commodities. So in recent examples, as you can see by the graph, we've had the Persian Gulf War, 1990-91. You can see there's a slight dip, which was roughly around about 10% after the invasion of Kuwait by Iraq. However, straight after, we had the following year, we had a 20% rise in the share price, in the market, the Australian market in particular. In September 11, the attack on New York, well, basically the market fell roughly about 5% immediately after the aftermath in the Australian market. You can see it there on the blip. But after that, the market rose 15% in the following year. The same thing happened with the Iraq War. The market fell 10% with the invasion of Iraq by the United States and its allies, but market quickly rose by about 20%. And you can see that during that whole period, it really went strong. Obviously, the GFC came into fruition, and that took a bit of a spanner in the works. But leading up to that and leading through that, well, the market ran very, very well. Now we come to more recently, well, the Russia invasion of Ukraine, and the Australian market fell 5%, but months after that recovered quite well to invasion, to pre-invasion levels, and then realistically almost all-time highs. So looking at the market now and where we are now, a week gone by since the invasion, we're seeing a lot of defensive stocks that traditionally have done well in the market, and some that we're even picking up and have been picking up for quite a while, perform well. And those are gold, wheat and grain, and oil. Things that are used to hedge the market, things that are known to be very scarce in war times and always are needed, and things to let our economy run. So Newcrest Mining after the invasion on the Monday did 5.9%. Northern Star did 5.37%. Evolution did 4.64%. We had wheat and wheat and grain through Grain Corp to 7.99%. We had Eurofarm do 3.79%. We had oil stocks, which we spoke in our last video about. Woodside Energy do 3.1%. We had Santos do 2.9%, and Karoon Energy do 4.7%. And I'm not going to stand here and say that these areas won't perform in the future. They can perform, but they do perform very well out of a wartime period. Even one that's not mentioned on the slide is coal. Does really well. It's because these commodity prices and the disruptions in supply that the price of these commodities run high. They jump. And if we have an all-out war in the Middle East and it gets worse, well, I can only imagine how high oil prices will go. So that brings me to, what are we buying? Well, we're buying gold. We have been. We've picked up a few speculative plays in the past and in recent history. One, namely, is Red 5, which we did very well out of. But we're picking up one at the moment, which we're very confident to see a 20% upside for. So if you're looking for an opportunity, download our free stock recommendation, have a bit of a look into the information there. And if you're looking for a bit of help of what to do on your individual portfolio, well, give us a call. Find out what else we can do for you. I'm confident to say that we've been outperforming the market quite considerably. But it's the sort of thing where if you're not too sure what to do or what to change about your portfolio, speak to an advisor, speak to a professional that's looking at the market every day to give advice on what sort of sectors to be rotating in and out of. And I know from just talking to a lot of viewers and a lot of recent clients that have come on board, is there's a lot of stocks that have been overweighted in a lot of portfolios, and there needs to be a bit more defensive play going forward. So that's it for this video. I hope that really helps clear some minds and provide a bit more information towards people. We look forward to seeing you in our next one. We might have a bit more of an update. If not, don't forget to register for our Weebit webinar, which is occurring in the next couple of days. So we'll talk about that very soon. But apart from that, have a lovely day. And my name's Lachlan Callaghan, Trading Floor Manager from Sharewise.